This lecture is presented by John Moffat of Open Tuition. For other free lectures, visit opentuition.com.
Let's look at the last question on the September-December 2015 hybrid exam for paper F5. So it's question 5. Make sure you've got the exam question in front of you. And the requirements, A, for each division for the year ended 31st August 2015, calculate the appropriate closing return on investment on which the payment of management bonuses will be based. Briefly justify the figures used in your calculations. 5 marks. And to make sure you didn't miss what was asked, you've actually been told how the marks are split. It wasn't just calculate the return on investment, it was justify the figures that we were using in it. B, based on your calculations, calculate each manager's bonus for the year, 3 marks. And finally, C, discuss whether ROI is a fair basis for calculating the bonuses and the problems arising from its use, August 2015. So part C is the written bit, but it is 7 marks out of 15. So although in theory you could just about pass the question on parts A and B on the arithmetic, albeit part of A is discussing, you must make sure you left time to write something for part C. We'll have a chat when we come to it. But it may be hard to get 7 out of 7, but it should always be easy in any written question to get a few marks, and hopefully therefore make absolutely sure you get more than the 50%. Anyway, let's go back and read the question. Cardale Industrial Metal Company is a large supplier of industrial metals. There are 2 divisions, F and N. Each division operates separately as an investment centre. So if they're an investment centre, they're responsible for decisions on buying new machines, etc. And each one has full control over its non-current assets. In addition, both divisions are responsible for their own current assets, controlling their own levels of inventory cash, having full responsibility for the credit terms to customers, collection of receivables, balances. So they're responsible, they have authority over all their assets and liabilities. Similarly, each division has full responsibility for its current liabilities and deals directly with its own suppliers. Each manager is paid a salary of $120,000 a year plus a performance-related bonus based on the return on investment and achieved by their division. Each divisional manager is expected to achieve a minimum ROI of 10%. If they only meet the 10% target, they're not awarded a bonus. But for each whole percentage point above 10 that they achieve for the year, a bonus equivalent of 2% of annual salary is paid, up to a maximum of 30% of annual salary. Anyway, we'll worry about that later. If you remember, part B was asking about calculating the bonus. The following figures relate to the year ended August 2015. So we've got profit figures, the first bit of the table, and then below, information about assets and liabilities. During the year ended August 2015, Division N invested 6.8 million in new equipment, including a technologically advanced cutting machine, which is expected to increase productivity by 8% a year. F has made no investment during the year, although its computer system is badly in need of updating. F's manager has said that he's had to delay payments to suppliers because of limited cash, and computer system will just have to wait, even though the cash balance at F is better than N. Anyway, we've read the whole thing, but in fact, it's not all relevant right from the beginning. Part A, for each division, calculate the return on investment on which the payment of bonuses will be made. Well, for the return on investment, it's basically the profit as a percentage of the net assets. But since it's measuring the performance of the manager, we need to take the controllable profit, how much of that profit for each of them is under the control of the relevant manager? Well, I think it's made pretty clear. For each of them, you give them the sales, you're told the controllable profit. There's also an apportionment of head office costs, but head office costs aren't under the control of the relevant manager. So the controllable profit is 2645 for F and 1970 for N. For ROI, we want that as a percentage of the controllable net assets. Well, it made it very clear in the first paragraph that the managers have control over all the assets and liabilities. They control the non-current assets. They're responsible for their own current assets. Full responsibility for current liabilities. So what is it? F, the current assets are 9760. The non-current assets are 9760 plus the current assets less the current liabilities, which for F gives us 9280, whereas for N, 14980 non-current, 3260 current, 1400 liabilities. Is 16840. These are all in thousands, of course, but no problem. Which means the return on investment for F, 2645 over 9280, which is 28.5%, and for N, 1970 over 16840, which is 11.7%. So in terms of the calculations, that's it. We're not asked to comment as yet which is better, F or N. Although it does say briefly justify the figures used in the calculations. I'm not going to write it. Obviously in the exam you must write it, but I've actually spoken about it. We've only used controllable profit because the managers don't have any control over the apportionment of head office costs. We've used all the net assets because that first paragraph made it clear that they're all under the manager's control. You know, if it wasn't an investment centre, for instance, if it was head office who controlled our non-current assets, then we'd have left them out. But here, no problem. All right, so otherwise that was, I think, was easy enough. What about part B? Based on your calculations in part A, calculate the manager's bonus. Now, I think I've said one or two times in the lectures on the earlier questions, you don't lose marks twice. So even if you'd made a mistake in part A and got either of those figures wrong, you would still get full marks in part B if you calculated the right bonus on your percentages. So don't be frightened of losing marks twice. Get that wrong and you've lost half a mark, whatever. But you wouldn't lose more marks for part B. However, mine were right, so now let's look back. The bonus, they're expected to achieve a return of 10% for their division. Well, they both do, so they both get a bonus. For each whole percentage point above 10, so I will write it down here. The first division, Division F, got 28.5. So that's 18.5% points above 10, or in whole points, it's 18. 28.5 minus 10 is 18.5, but it's 18 whole percentages. Similarly, the other division, n, 11.7 minus 10 is 1.7. In whole percents, it's 1 percentage point. Well, for each percentage point, they will get a bonus of 2% of their salary. Which means F would get, for the moment, 36% of the salary as bonus. N would get 2%, except that it is limited. It says there's a maximum bonus of 30%. And so as far as F is concerned, it was coming to 36%. It'll be limited to 30%. And so what will the bonus be? Fn. F's was limited to 30% of salary. So 30%, the annual salary is 120,000. So he'll get a bonus of 36,000. Whereas N, way below the limit, is 2% of annual salary. And I should be able to do this in my head, but I always get the number of decimal places wrong. It's 2,400. So there we are. Part B, the bonuses. That was nice. I don't know, I'm repeating myself. I think that was very, very easy indeed. In that even if you got part A wrong, you get full marks for doing part B right on your figures. It was just the time it took, obviously, to read that second paragraph. There's that danger, I fully appreciate when you're rushing, of misreading. So, although we have just about passed the question with 8 marks out of 15, I said before, you can't not do anything for part C. You've got to make sure that you get some marks from part C, both to be extra confident of passing, but also in the middle of an exam you're not certain that you've not made a mistake in part A and B. Discuss whether return on investment is providing a fair basis for calculating the bonuses and the problems arising from its use at CIM. Now, as I've said so many times, and I've been through the earlier ones, I am not going to write out a full answer. You've got the examiner's own answer. You can download it from the ACCA website and read it and learn from it. But as I keep saying, remember, the examiner always writes far more than you're expected to write in the exam. For me to write it all out would be a bit silly, sort of effectively copying out the examiner's answer and get boring. But let me just stress the main points that you should have been thinking about. But make sure you write them down. You try and write sentences, not just the odd word. Is it providing a fair basis? Now, although this isn't directly answering the question, I would make the point right from the beginning that F clearly is being paid a much, much bigger bonus than N. And it's really a question of, is that fair? A few things you could look at, but the first thing I would look at, because you're given clues as always, the examiner always gives clues as to what's required in written bits. Look at the last paragraph of the question itself. During the year, Division N invested 6.8 million in new equipment, including a technologically advanced cutting machine, which is expected to increase productivity by 8%. Now think about that. Because of that huge investment, N's controllable net assets at the end of the year are 16, remember that's million, everything's in thousands, so it's 16.8 million. 6 million of that, 6,800, in thousands, is this new machine. So the controllable assets have gone up enormously. It's expected to give us more profits, but because we only bought it this year, it's unlikely that it's had much effect on this year's profit. And if that 6,800 wasn't there, if they hadn't made the investment, this would only be what? 10,040. And if they'd made 1970 profit on that, 1970 on 10,040, that would have been 19.6% return on investment. It'd be much higher, then you get a much bigger bonus. And so it's, in that sense, it's unfair. All right, in next year, hopefully, if this does give us much more profit next year, the ROI will be higher and we'll get more bonus. But this year, it is a bit ridiculous. One of the reasons N is getting such a low bonus is because they invested in this new machine, and yet this new machine, presumably, is going to be good for the company as a whole. Presumably, the company wants them to invest in this new machine because we'll get more profits in the future. But the manager is going to be a bit upset that he did it. If I was manager and knew how my bonus was being paid, I might have said, I'm not going to bother buying the machine because it means I get less bonus. What else is in that paragraph, though? Division F has made no investment during the year, although its computer system is badly in need of updating. Well, think about that. It's badly in need of updating. So really, we do want them to have a new computer system. And if they did have a new computer system, I don't know how much it would cost, but surely, if they had bought the new computer system, the net assets would be a lot higher. It may cost them another million, 2 million, I have no idea. And if it had been a lot higher, the new computer system, I think that's less likely to give us more profit. It might, but not like a machine. Certainly, and investing in a new machine, it says quite specifically that will give us more profit. A computer system is less likely to, but even if it was going to increase the profit, a bit like with N, it probably wouldn't be till next year. So if they had invested, controllable net assets would have been higher, profits probably wouldn't have changed. Well, if 2645 is a percent of a higher figure, their return on investment would be lower, and they'd have got less bonus. So the examiner made it very obvious that, why was all that information there? That last paragraph was completely irrelevant for parts A and B. It was there to give you the clue that it's not leading, paying them the bonus this way is not leading, actually, to sensible decisions. We want N to invest in this new machine, and fortunately N has. He's done what's good for us. But you wouldn't have been surprised if he hadn't done. He's going to be very upset, not getting hardly any bonus and seeing what F's getting. F hasn't actually done as much good at all, in that F should have surely upgraded their computer system. They haven't, presumably because they knew it would hurt their bonus. And yet we're giving him this huge bonus when he's not really done what we probably wanted him to do. Again, I haven't written that down. I'm not going to. I hope what I said made sense. And that's not everything for 7 marks, but that would certainly, those 2 big points. Although N has invested, that's what's dropped his bonus. You wouldn't have been surprised if he hadn't have invested. On the other hand, F should have invested and hasn't, but he's got a good bonus. Those 2 points might not get you all 7 marks, but would certainly get most of them. I've already said read the examiner's answer. She's mentioned 1 or 2 other things which I think are slightly less important, but most of her answer relates to those 2 points I've just made. And bear in mind for the future that although I don't think A and B were too difficult, I really don't, that even if you had gone wrong on parts A and B, even if you got stuck on parts A and part B, or had no idea how to understand that paragraph about the bonus, you could still have had a good shot at part C on its own. You didn't actually need any figures. You could have had a good shot on its own, just on the information in that last paragraph. Anyway, I'll leave it there.